So what I'm concerned about with Bitcoin is this is since the BlackRock announced their application for an ETF, Bitcoin's dropped from 25,000 to 20, almost 28,000. That makes sense. About 10%. But that's still hopium. We have to hope to get that ETF. It's probably going to happen now because it's BlackRock. We're all in there, and everybody's thinking that. But if you look at Bitcoin versus the NASDAQ, that ratio, it's like 1.7 or so. It's the same as first traded in 2017. So I'm big picture macro bullish Bitcoin. But I think the problem is if I'm right about risk assets declining in a normal recession, cryptos are the riskiest assets. Bitcoin's the least risky.
Mike McGlone is a prominent analyst and market strategist known for his expertise in commodities, cryptocurrencies, and macroeconomic trends. With a successful track record as a former commodity strategist at Bloomberg Intelligence, McGlone has consistently provided invaluable insights and market intelligence to institutional investors and financial professionals. During the interview, McGlone mentions the significant development for crypto investors as Bitcoin has surpassed $28,000. Reaching its highest point this month, fueled by BlackRock's bid to establish a US ETF. On June 15, BlackRock submitted an application for a Bitcoin ETF to SEC. While the SEC has previously shown reluctance to approve such funds, this recent attempt carries weight due to the involvement of the world's largest asset manager. The BlackRock ETF application seemed to have sparked the rally, but there are certainly other factors at play, remarked Aaron Brown, a crypto investor and Bloomberg opinion contributor. As per McGlone, "Don't fight the Fed" mantra remains a strong headwind for Bitcoin and crypto prices. The cat-and-mouse game between the rallying stock market and watchful central banks could be an obstacle for risk assets. The Bitcoin-NASDAQ ratio is currently around 1.7, similar to the ratio observed when Bitcoin first started trading in 2017. While McGlone maintains a bullish long-term view on Bitcoin from a macro perspective, he believes that if traditional risk assets, such as stocks, decline during a normal recession, cryptocurrencies, including Bitcoin, may face significant downside risks. McGlone suggests that during a serious U.S. recession, Bitcoin may eventually behave more like gold and long-term bonds. Mike shares the belief that Fed has consistently stepped in to save the market whenever it faced downturns over the past 15 years, while he raises doubts about the effectiveness of relying on the Federal Reserve's intervention to protect the market. We will now bring you clips from Mike McGlone interview with David Lin. Before we proceed further, please make sure that you subscribe to our channel and click the bell icon to stay updated.
They still have a lot of downside risk based on my view of a serious U.S. recession. At some point, Bitcoin's going to come out of that and trade more like gold and long bonds. Is this the time? Maybe, but it's got to show me more divergent strength. Like today's one day, Nasdaq's down 0.2 and Bitcoin's up 4. That's one day. But overall, you look at Q2, Bitcoin's had a horrible quarter, and Nasdaq's been up. And why? Okay, so we've had we've had the SEC crackdown. Yes, that makes sense, but that shouldn't really hurt Bitcoin. It should really hurt the other cryptos, the other 25,000 that are just fully, way overhyped and speculated. It's just too much, seriously, speculation. I remember I used to see a lot of the trading pits. This makes those look that hype look like sissy stuff. So that to me is we need to get through that period, but right now there is not that ETF that people are bidding Bitcoin on, and it's the overwhelming macro that I'm concerned about. That if I'm right about markets just doing what they normally do in deflationary recessions, as indicated by the yield curve and commodities, and Fed's still tightening, Bitcoin's still going to have some major pressure factor. You being realistic about your views for recession and asset allocation, or are you focusing on what's helped and done well for at least the last almost 15 years, with the Fed being there to save you every time something went down? And that is, I think, the key question that investors need to ask themselves. And I hear it so much. Everybody keeps telling me, oh, you got to buy equities because the Fed is going to cut rates as soon as the market goes down. The Fed put is still there. That's what I like to point out in that piece you pointed out, is I think the Fed put's gone. And let's give it a test. We haven't had a test. And let's see what happens in the test. And that's why I'm looking for that test of Bitcoin. If we get that rollover in equities, if we can see divergent strength in Bitcoin for the quarter, so far Bitcoin's is trading very poorly. So to me, that's the key thing. It's also what I fully expect. It's human nature. It always happens. It's just sometimes you can see it and expect it, and then you have to find it in the data. Like, why did some of us fully expect a massive amount of demand destruction in commodities last year and decent amount of supply elasticity to pick in? Because of price. prices always makes that happen. The key thing I like to point out is that happens more than ever now because of rapidly advancing technology. Obviously, that's good for things like Bitcoin and NASDAQ in the long term, but the shorter term, next couple of years is getting through this period of economic contraction in the U.S., which is completely being orchestrated and planned by the Federal Reserve, which is still taking away the punch bowl.
During an interview, Mike McGlone expresses his concern about a recurring pattern he has observed in major market movements throughout history. He referred this pattern as a wall of hopium, where investors become overly optimistic and ignore historical evidence pointing towards an impending recession. McGlone cited the New York Fed's estimate for recession currently stands at 70%, the highest since 1982. Meanwhile, McGlone presents a scenario for the recession where gold reaches $3,000 per ounce while the S&P 500 drops to 3,000 points, resulting in a 1-to-1 ratio between the two assets. McGlone highlighted the Fed's decision to raise interest rates beyond what would be expected based on declining inflation. This deviation from the normal cycles of "don't fight the Fed" indicates a potential worsening of aggregate conditions. Looking at the futures market, McGlone noted that the market still expects a 25 basis point hike in July. The ongoing cat-and-mouse game between investors and the Fed raises concerns about the potential consequences of ignoring warning signs, as Mike McGlone mentioned in his recent report on May 24th, cat-and-mouse game that could crush the global economy.
So here's the narrative. Gold versus the S&P back over 100 years has been as high as, S&P divided by the gold is basically the mean is about 1.2. The high has been about 1.3, and it's around the low right now. S&P is like double the price of per ounce of gold. So here's one scenario for the recession I'm looking for. Gold pops to 3,000, S&P drops to 3,000. That's a 1-to-1 ratio. And if you go back 100 years, that ain't much. Needs to be pointed out. You don't earn interest in the gold. You don't have dividends in the S&P 500. You do that. I'm just pointing out the fact of the ratio of the two assets. The most significant measure of risk assets on the planet is the S&P 500. And it's maybe double the price of gold right now. As we head towards a recession, I think they're going to head towards one, which is not profound. 1-to-1 parallel ratio per ounce of gold, because that's almost always what's happened in recessions, and we haven't even got started, and the Fed's still tightening, which basically implies this is probably going to be one of the worst recessions in our lifetime. Right now, I look at it, opening up my potential crystal ball, I think it's more likely gold goes to 3,000, S&P 500 goes to 3,000. Now, that's going to see a lot of iterations, and that's the risks of making predictions. But this is what I see right now, and particularly because there's virtually no one who is bearish the stock market. They have been by the strategists. And that, to me, is where you usually get good bear markets, is when you have a fundamental underpinnings for a very bad period for equities, if you just follow the rules of liquidity and recessions. Now, one thing I find very disconcerting, and this almost always happens in the biggest moves ever, i.e. 1930, is markets will go up into like a wall of hopium, thinking things will get better and ignoring the facts of history that stock market is bouncing into a recession as even started. You look like at the New York Fed estimate for recessions from the yield curve, it's at 70%. That's the highest it's been since 1982, I think. So you look at the yield curve, and then there's so many indications here that you're supposed to be very careful, yet investors are kind of double dog daring the Fed. And the bottom line is that's kind of the cat and mouse game. And that, to me, is just like the commodity market, what turned out to be its worst enemy. When it went up too much, it just squashed demand and brought on that supply, and everything collapsed, and still collapsing. That's a problem. Crude oil's down another almost 2% today. The stock market is doing it in a different way by staying strong into this hopium that we're only going to get a soft landing or no recession. It's keeping the Fed vigilant, which I think is going to aggregate things and make it worse. They're hiking rates well above their trajectory for declining inflation, which means just the normal cycles of don't fight the Fed are still don't fight the Fed. You look at Fed funds futures for the next money for July, they're still priced for 70% for a 25 basis point hike. And the key question I like to ask myself is, what's the number one force that can stop the Fed and a lot of other central banks from still tightening? And that's the stock market rolling over. Until it does, the Fed's probably going to remain vigilant. There's your cat and mouse game.
Looking ahead, it becomes crucial for investors to carefully assess the signs of a looming recession and not overlook the historical patterns that have preceded major market downturns. While Bitcoin's recent rally, fueled by BlackRock's ETF bid, showcases its potential as a diversification tool, the looming risks associated with a global economic downturn cannot be ignored. Navigating this challenging environment requires a balanced approach that considers both the long-term macro bullishness of Bitcoin and the potential downside risks during periods of economic contraction. Given the potential risks posed by an impending recession, how do you view the role of Bitcoin in your investment strategy? Are you more inclined to perceive it as a safe haven asset like gold, or do you believe its volatility makes it vulnerable to downside risks during economic downturns? Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel. And don't forget to turn on notifications to stay informed about our latest videos covering more interesting topics. Thank you for watching.